Hello and good morning. I'm Helen Miller, Director of the IFS, and I'm delighted to welcome you to this morning's event. Regular viewers will know that we've been releasing chapters of the Green Budget over the last few weeks, and today we're releasing a chapter looking at Rachel Reeves' tax options for the budget. I think it's fair to say that it's now widely expected that Rachel Reeves will increase taxes in the November budget, even though she said quite clearly last year that she didn't want to come back for more. In a nutshell, that's because the OBR has almost certainly handed her a forecast showing that without policy action, day-to-day spending will be running ahead of revenues in 2029-30. That would break her borrowing rule. I think put differently, and using the common jargon, Rachel Reeves has almost certainly seen her headroom against that borrowing rule wiped out. And that's partly because of government decisions to reverse planned cuts to disability spending, but it's also because the OBR will almost certainly have downgraded their judgment of productivity growth in the coming years. Now, we won't know exactly what those OBR assessments look like until we see the budget. But if that downgrade happens, and if Rachel Reeves wants to stick to her fiscal rules, and I very much expect that she will, she'll basically have to do a fiscal consolidation. That means cutting spending or increasing taxes. Of course, cutting spending she might find tricky because she only just finished the departmental settlements in the spending review in summer, and the Labour Party have struggled to get spending cuts through the Parliament. Doesn't mean they can't cut spending, but they might find it tricky. What we're going to look at today, however, is the possibility of raising taxes. We'll look at the different options she faces and the pros and cons of those options. But let me be clear that we are not saying that she should raise taxes or that tax rises are inevitable. They would be a choice. But as I say, it looks like a choice that she is likely to make. It's also worth saying we're not taking a judgment on exactly which taxes should raise. That is, again, a political choice. But a common theme you'll see throughout what we show you today is that there is a clear need to reform taxes, to think not just about how much revenue to raise, but how to raise it. One thing I'd like to emphasise is that although we'll see a lot of discussion of the politics in coming weeks, we shouldn't forget the economics. Tax rises are not all born equal. Some are particularly damaging to growth. And I think Rachel Reeves has a real opportunity here to grasp the nettle, to be bold, to reform taxes in a way that makes them less damaging to growth and to broader welfare. So with that in mind, I say we'll look at the options for raising revenue and highlight some of the places where reform is will be particularly beneficial. To do that, I'm joined by Stuart Adam and Isaac de Lestra, who are both colleagues here at the IFS and who co-authored the report we've put out today. Isaac is going to present to you for around 20 minutes, showing you the highlights of that work. We'll then have a chance for questions. So please put your questions into the Slido link that you have. You can vote for the ones that you would most like to see the answers to. I know there are very many of you watching today, so I will try to get through as many of those questions as we can. And then finally, before I hand over to Isaac, let me say thank you to the Nuffield Foundation and to Barclays, both of whom contributed funding for this year's Green Budget. But with that, Isaac, the floor is yours.
Thank you very much, Helen. So I'm now going to give you a bit of a whirlwind tour of some of the options that the Chancellor has, should she look to increase revenues in November. So let me just start off by giving you a broad overview of what the tax system will look like in 2029-30. That's the year in which the Chancellor's fiscal rules will bite. Now, I'm not going to go through this in any amount of detail, but broadly, there'll be about £1.3 trillion of tax revenue coming in that year. And one thing to notice is that almost 2/3 of that revenue is going to be coming from just three taxes, the three largest taxes in the UK: income tax, national insurance, and VAT. Now, generally speaking, a Chancellor on the hunt for revenue might well look to these taxes first. You could get a lot of revenue just by increasing rates by relatively small amounts. There's good reason to believe, however, the Chancellor might not turn to that option at the budget. And one reason for that is the Labour Party's manifesto. So at the last election, the Labour Party promised that Labour will not increase taxes on working people, which is why we will not increase national insurance, the basic, higher or additional rates of income tax, or VAT. Now, the first part of that promise is sort of quite hard to really make a great deal of sense of. Hard to see how you could raise much tax at all without taxing people who work. The second part, however, is a bit more specific. It does look like increases, and almost any increase to national insurance or VAT, is being ruled out. On the other hand, there does seem to be a bit more wiggle room when it comes to income tax. Only rates are being ruled out. That means there is still scope for base broadening or for reductions in thresholds. Now, one obvious way in which thresholds could be reduced would be to extend the freeze that we've seen to income tax and NICS thresholds since 2022. That's due to end in April 28, so the Chancellor could extend it by an additional 2 years. Oh, I'm afraid I think that's our fire alarm being tested, so just to bear with us for a second. Fiscal alarm bells ringing. So back to the presentation. So the freeze is due to end in 2028. That could be extended for an additional 2 years. That would raise about £10.5 billion. Worth noting, however, that if the freeze were applied to national insurance contribution thresholds, as it has been so far, as well as income tax thresholds, it does look like that would probably break the manifesto promise not to increase NICS. Also worth noting, this just isn't a great way to make policy. In general, leaving the real value of thresholds to be determined by the vagaries of future inflation isn't a very deliberate or a strategic way to make tax policy. Now, another option the Chancellor could pursue would be to create a new tax altogether. That's something some previous chancellors have done in the form of, for example, the apprenticeship levy or the health and social care levy. Those are both taxes that look pretty suspiciously like NICS. And the Chancellor could raise a lot of money by doing this, say by creating a new defence and security levy or NHS charge. But that would add a lot of unnecessary complexity to an already pretty complicated tax system. So overall, we aren't particularly keen to see the Chancellor do this. So the big three taxes, the three largest taxes, might be the most obvious place to turn to for revenue, but in various ways they're all pretty constrained. So where else might the Chancellor look to raise revenue? Well, one natural thing to do might be to continue down the list of the largest taxes in the UK. And if the Chancellor does that, she'll find the four next largest taxes are corporation tax, council tax, business rates, and fuel duties. So what are the prospects for revenue here? Well, let's start with corporation tax. This is a pretty large tax, and there is scope for getting more revenue here. But one reason why we might not see the Chancellor do that is the corporation tax roadmap, which was published in 2024 alongside the last budget. And that committed the government to maintaining basically all the major features of the current corporation tax system, really leaves very little scope for significant revenue raising. There are some small features that are left open by the roadmap. The bank surcharge, which is a higher rate of corporation tax charged on banking profits, is described as being under review. But even if you doubled that, you'd only get about £1 billion. And there are legitimate questions as to be asked as to whether banks should be paying a higher rate of corporation tax on their profits anyway. Now, one potentially more fertile avenue for raising revenue from corporation tax might be tax compliance. Now, what I'm showing you on this chart is the corporation tax gap. That's the share of revenue HMRC estimates to go uncollected as a result of non-compliance. And you can see that that's broadly been falling over the last 20 years or so, but that's not the case for corporation tax. In corporation tax, we've actually seen a pretty big spike in the tax gap over the last 5 years or so. Now, HMRC estimates this is entirely driven by smaller companies. Those smaller companies now have a corporation tax gap of about 40%. So 40% of the corporation tax the HMRC thinks they owe going uncollected. That's really very substantial. And overall, the corporation tax gap represents about £24 billion in lost revenue. So if the Chancellor could just return that gap to around its 2017-18 levels, that could raise about £10 billion. That's a pretty meaningful prize. But that might be easier said than done. We're not just talking about tweaking a tax parameter here, changing a threshold, changing a rate. Instead, we're talking about having to actually deliver better compliance and enforcement through HMRC. So that's corporation tax. What about council tax and business rates? Well, when it comes to council tax, the OBR is currently assuming that in England at least, council tax rates are going to go up by 4.3% a year for the remainder of the Parliament. What that means is if the Chancellor wants to get more revenue out of council tax, she's going to actually have to increase it above and beyond what the OBR is already assuming. Now, she could do that. An additional 1% increase would yield you about £500 million. Or alternatively, she could look to try and raise more revenue from just the highest value properties. So Scotland implemented a reform largely to this effect in 2017. You could copy that in England. Or more radically, you could double the rates on Band G and H properties, which are the 4% most valuable properties in the UK, and that could get you up to £4.2 billion revenue, depending on what councils chose to do. Although worth noting, that would be really quite a substantial tax increase for affected households, something in the order of thousands of pounds a year. Also worth noting that when it comes to targeting the most valuable properties, because valuations are currently so out of date, you'd actually be taxing the properties that were most valuable about 30 years ago, not necessarily those that are most valuable today. Revenues here also would end up, by default, going to local authorities and not to the Treasury. So by default, that isn't going to help the Chancellor with her fiscal rules. As for business rates, well, the Chancellor, the government rather, has got modest reform underway when it comes to business rates, but all the indications so far from the government have been that these are going to be fiscally neutral reforms. So it doesn't look like the government's planning to get any more revenue from that source. Now, property taxes are one of the worst designed parts of the whole tax system. So we have council tax rates that are still absurdly based on 1991 property values. We've got business rates that distort production decisions, drag on growth, and we have stamp duties that lead to pretty horrible misallocations of property. So what we'd ideally like to see in the budget, whether or not the Chancellor is looking to raise revenue from property taxes, are steps towards a reformed system. Now, in the IFS Merley's review, the kind of end goal that was set out for property taxes was moving to a land value tax on commercial properties and then having a proportional tax on residential property values based on up-to-date valuations. And that together would replace business rates, council tax and stamp duty and leave the whole system looking a lot more rational. So it'd be nice to see the Chancellor taking steps in something like that direction. So the final tax on my list of the four next largest taxes are fuel duties. What are the prospects for raising revenue there? Well, as most people are aware, we've had a long-term pattern of chancellors not increasing fuel duties in cash terms. And in fact, we haven't seen fuel duties go up in cash terms since January 2011. What the OBR is assuming, however, is that RPI inflation indexation of fuel duties is going to resume next year. Not only that, but we're going to see the end of the temporary 5p cut to fuel duties that was put in place in 2022 and has been extended ever since. Now, what that means is that we'd be looking at, under the OBR forecast, a combined cash increase of almost 20% in fuel duties by 29-30. For the Chancellor, the implication of that is that any additional revenue she wants to raise to help her with her fiscal rules would mean increasing fuel duties above and beyond that level. If she wanted to not do that, she wanted to leave duties frozen at their current rate. That's something she did at the last budget. Well, by 29-30, that would end up actually costing a lot of revenue, about £5.5 billion. Now, again, motoring taxation and fuel duties are an area that are ripe for reform, not least because it's currently government policy that no new petrol or diesel cars are going to be sold from 2030. And in the long run, that means that almost all revenue from fuel duties is ultimately going to be lost, as well as much of the revenue from vehicle excise duties, although it's easier to see how that could be fixed. And the government really needs a plan to deal with this. It's a substantial amount of revenue that's going to be lost. Now, of course, you might argue that there's no reason that revenue necessarily should come from taxing motoring, particularly when we move to a world where we have zero-emission vehicles. But actually, a lot of the cost from motoring comes not from carbon dioxide emissions, but rather from the congestion costs imposed on other road users. And that means there is still a good argument for having some kind of motoring tax. And probably the best option for doing that would be some kind of road pricing, a charge per mile driven perhaps, but ideally something that a charge that was higher in congested areas or at congested times. So we've seen that the three largest taxes in the UK are all fairly constrained for political reasons, but also that the next four taxes don't offer any very easy options for raising substantial revenues. So where else might the Chancellor look to? Well, one option would be to look to taxes on wealth and savings. Now, one element of the wealth and savings taxation system is the taxation of capital returns. So what I'm talking about here are things like rental income from property, interest income, dividend income, capital gains, something that the Chancellor turned to in her last budget to raise revenue. Now, this might look tempting for the Chancellor. It might look like, for instance, she isn't taxing working people, although I think in reality that's pretty dubious. It's also the case, and this is an entirely legitimate point, that many of these kinds of income are actually taxed at substantially lower rates than employment income. And that does create real concerns both for fairness, but also for efficiency, where you have people potentially seeking out more tax advantaged forms of income rather than looking to work in the way that's necessarily most productive. So the Chancellor could increase rates in this area. She could increase rates on dividend taxes, on interest income. She could reduce some of the generosity of allowances of the system around capital gains tax. Or she could increase capital gains tax rates, although it's worth noting the HMRC currently estimates that increasing capital gains tax rates would actually reduce revenues. Now, behavioural responses are really quite uncertain in this area, so we shouldn't take that as gospel, but it's at least interesting that's what the HMRC thinks. But if the Chancellor did do this, did look to increase rates on capital returns, that would imply a trade-off. So on the one hand, yes, she'd be reducing the gap between the rates at which these kinds of incomes are taxed and the rate at which employment income is taxed, and there's a lot to be said for that, although worth bearing in mind she'd also be increasing other gaps. If things like ISAs remain tax advantaged, they would look even more attractive relative to the rest of the system. But on the flip side, she would also be worsening disincentive to save and invest, and also exacerbating other distortions in the system as a result of the fact that the capital income tax base in the UK is really quite poorly designed. Now, there is a way through this impasse if the Chancellor wanted to take it, and as you probably guessed, that again involves tax reform. Realise I'm starting to sound like a bit of a broken record here, but what the Chancellor ultimately should be looking to do is implement real reform in this area. Now, I haven't got time in 60 seconds to fully explain how that would work, but just to give you a very broad overview of what a good end goal might look like, it'd be good to see the Chancellor looking to fix the tax base, maybe by giving full deductions on saving investment, and also fixing some of the problematic features of current capital gains tax. And that would then allow the Chancellor to align rates more fully across different sorts of income and get rid of some of those unfairnesses and inefficiencies that causes. And you'd end up with a tax system that looks not only fairer, but also more efficient and growth friendly. Now, something else that's been discussed quite widely ahead of this budget is the prospects for an annual wealth tax. Now, we don't think that's a particularly attractive idea, and there are three reasons why we think that. First of all, this would have all the disadvantages of distorting saving and location decisions that already exist in the unreformed capital income tax system. Secondly, it actually wouldn't help you tax very high returns to capital, which is something there is a good argument for taxing. So this really wouldn't be a substitute for properly reforming, properly fixing our capital income taxes system. And finally, there would be really enormous practical difficulties in making a wealth tax work. You'd have to value vast swathes of assets that are owned by people, and that can be really practically difficult, particularly when it comes to things like private businesses. Working out the proper values of those would be extremely difficult, a huge bureaucratic undertaking. International experience also isn't encouraging here. Most countries that have had wealth taxes no longer do have them. And we think the Chancellor's efforts would be better directed towards fixing current taxes rather than creating a new wealth tax. Now, one other element of the saving and wealth tax system that the Chancellor could look to for revenue is the taxation of pensions. Now, just to remind people how income tax currently works when applied to pensions, contributions to pensions are exempt, returns earned while investments are in the pension are also exempt, and then withdrawals are taxed. Now, that's a relatively coherent approach to taxing pensions, and it has some nice features. Firstly, it avoids some of the penalties to a saving that are caused by the capital income tax system. Second, it allows people to reduce, at least some people, to reduce the tax penalty that exists for volatile incomes when you have an annual progressive income tax. And finally, it provides the government with revenue at the point where it actually needs it. So retirees tend to make more use of the NHS. They have state pensions. They're quite costly to the state. Useful to have a tax system that delivers more revenue when you have more retirees. So the Chancellor could look to change this system. She could look to cap relief on upfront contributions to, say, 20%. And if she did that, she could raise a lot of revenue. She could raise up to £22 billion. But that would also make the system probably less fair and certainly more distortionary. And there would also be major practical difficulties to doing this. And the main reason for that is that it would involve having to value contributions to defined benefit pensions, which is not an easy exercise to undertake. We think better options for revenue raising, if the Chancellor does want to look to pensions taxation, would be to look again at the system of NICS relief on employer pension contributions, which currently costs about £30 billion. For instance, the Chancellor could look to impose employer NICS on employer pension contributions. Something else the Chancellor could look at is the tax-free 25%. That's actually very poorly targeted at the moment at people who are at risk of undersaving, and you could make it much less generous while still preserving incentives or even strengthening incentives for those who look likely to save too little for their retirement. So I obviously haven't covered every tax in the system there. There are a whole range of other smaller taxes, from inheritance tax to gambling taxes and all the rest, that the Chancellor could raise revenue from, although some of those would be a better idea than others. And the insurance premium tax deserves a special mention as something the Chancellor would be much better off not trying to raise revenue from. Now, taken individually, none of those is going to yield an enormous amount of money, but if you added up the revenue from many different changes, you could get a substantial amount of revenue. It'd be hard to get a very, very large amount, though. Now, one area that does deserve a special mention where the Chancellor could get a really substantial amount of revenue, at least in the medium term, would be a genuine economy-wide carbon tax. Now, this is an area where current policy is pretty fragmented, it's pretty confused, and bringing greater coherence and greater consistency to the taxation of carbon would have a lot of benefits, and it could also, if the Chancellor wanted it to, bring in quite a lot of revenue to the Treasury. So let me just come to a few conclusions before we take your questions. It's pretty well known that the Labour manifesto imposes some serious constraints on the three largest taxes. But I think what's been less discussed, and what hopefully I've tried to draw out, is that the next four taxes, corporation tax, council tax, business rates and fuel duties, are all pretty difficult too. There are no very easy options for raising revenue there. Now, it is still perfectly possible for the Chancellor to raise billions of pounds, perhaps tens of billions of pounds, without breaking the Labour manifesto's promise on those three largest taxes. Although much harder to see how she could do that without taxing people who work. But the fact that there are so many restrictions on what the Chancellor can do, so many self-imposed restrictions, does mean that there's a much greater risk the Chancellor end up going for a revenue-raising option that is particularly and unnecessarily damaging to the economy. Now, pretty much any increase in tax that the Chancellor chooses to undertake probably will drag on growth to some extent. And so if the Chancellor is as focused on growth as she claims to be, that means there is even more reason than usual for the Chancellor to look toward tax reform to try and cushion some of the impact on efficiency and growth that tax rises will ultimately end up having. So that's all from me. I'll hand back over to Helen now, and we can take your questions.
Brilliant. Thank you very much, Isaac. And thank you to everyone who's sending in lots of fabulous questions. So keep sending them in and keep voting for the ones that you'd like to hear the answer to most, and we'll get through as many as we can. So let's start with the most popular question, which, and I'm going to ask this to Stuart, because it's one of his favourite topics. Has the IFS taken a view on a reduction in the VAT registration threshold? I guess a reminder for those listening that the registration threshold is £90,000, but if you have a turnover below that, you don't have to register for VAT. And then there are commonly calls for that to be lowered. So Stuart, the VAT threshold.
Yeah, so the short answer is no, we haven't taken a view on it. There is potentially a bit of revenue that could be raised there, not a huge amount. I mean, HMRC thinks that the whole cost of having a registration threshold at all is about 3 billion. So at the most, you could realistically get 1 or 2 billion by reducing it. The UK's threshold is very high by international standards. Now, actually, many people in the past have argued that that's a strength of the UK VAT, not a weakness. And the reason we have a threshold, and one advantage of it being relatively high, is that it means you don't get large numbers of small businesses having to deal with the compliance costs of dealing with VAT, and indeed HMRC doesn't have to face the cost of administering VAT for large numbers of firms with very low turnover, where actually the amounts at stake would be pretty small anyway. Now, one interesting point there is that you do see, as a result of this, a lot of bunching, a large number of firms just below the threshold, clearly staying below there, either just to avoid the tax bill that's incurred when you go above the threshold, or to avoid the compliance costs of having to deal with VAT once you cross the threshold. Now, interestingly, as Helen says, there have been people looking at that and saying, well, the fact that you see lots of firms bunching below the threshold obviously means we should make the threshold lower. Interestingly, I've also seen many people arguing that, and I saw this, there was a parliamentary debate on the VAT threshold over the summer, where there are a lot of MPs were saying the fact that there's bunching below the threshold obviously means the threshold should be higher. And actually, it's not clear either way. The academic literature suggests it's ambiguous whether the potential for behavioural response means that the threshold should be higher or should be lower. Either way, the bottom line is no, we don't take a view as to whether it should be higher or lower. There is an argument for lowering it. You might be able to raise £1 billion or 2 at most like that. I also think actually the more fundamental thing is the way we do a VAT threshold at the moment the right way to do it, as in having a complete exemption, or at least a voluntary complete exemption. You can always choose to register for VAT if you want to, is having an option to be exempt from VAT if you're below the threshold, the right way to do it. And there are other options. So, for example, you could have a simplified system, like just a straight turnover tax, if you're below some threshold. So that actually the government doesn't lose as much revenue, and there isn't as big a jump in liabilities when you cross over it, but without facing these smaller businesses with a huge burden of complying with their obligations. So I think that is one of a number of more imaginative options that you might look at if you're thinking about what to do with VAT and small businesses. It's not necessarily just a question of putting the threshold down or indeed up.
Great, thank you. Isaac, I'm going to come to you with this question about land value tax. The question is, why have a land value tax on commercial properties and not residential? Why add unnecessarily complexity to the system?
Sure. Well, the main reason for that is that it's sort of a well-established principle in the academic literature that you should try not to tax any inputs to sort of to commercial activity, to businesses, because when you do that, what you end up getting is a tax that sort of cascades through the system, leads to all sorts of nasty distortions in firms' production decisions. And so, to the extent that buildings are an input into into firms' production, we don't want to be taxing buildings. We don't want to be disincentivizing firms from building new headquarters, building new factories, whatever it may be. And so, for businesses, we really want to take the component of property values that's made up by the buildings rather than by the land out of the tax altogether. Now, when it comes to residential property, one feature of our current system is that we don't have VAT on new build property or on any of the value that people get from living in their houses. So compared to other forms of consumption, it's undertaxed. So there is more of an argument for having sort of a VAT-like tax charged on the value of your property, on the value that you get from living in your property. And so that's the reason why there are different treatments for residential and business properties in the recommendations that we've set out.
And what I'd add to that is that the question also asked about complexity. I actually don't think what we're proposing is more complex. We can't have a system where council tax is based on dates from 30 years ago. So we are building houses and have to work out what they would have been worth had they been built in 1991. That's not simplicity, is it? We have a business rates system that has all these sorts of carve-outs and always being tweaked and fiddled with because governments know it has problems. We have a stamp duty tax. We're proposing getting rid of all three of those effectively and having two much simpler taxes. One is just a simple tax on land values and one is a simple tax proportional to property value. So I think actually what we're proposing is similar. Okay, let's take a question about wealth taxes, because there are a bunch of related questions here. So a comment, I'm going to try and find quickly, was basically to the form of, I care about inequality, wealth inequality, I want a wealth tax. And then one of the questions that's been voted up is Norway and Spain have wealth taxes that raise quite a lot of money and their economies are broadly performing well. Why wouldn't these approaches work here? Perhaps I'll start and then I can bring others in. So I think there are three things to know. And I assume by here we're talking about a wealth tax, meaning a new tax on the annual stock of wealth. I think there are three things to know about those types of taxes. One is that they have downsides. They have disincentive effects. They disincentivize savings and they can also encourage people to leave the country or not come here in the first place. I think the more you are concentrating them on a very small number of people, rather than on all of us and all of our wealth, the more you would expect people to be moving out of the country. So they come at real costs. The second is that they are practically very difficult to do. It is very difficult to value lots of wealth, including things like private businesses. So it's a big administrative burden to do this kind of thing. And third, I think perhaps most importantly, I think there are better ways to tax what we actually want to tax. So if you think about people holding wealth, people getting lots of big returns from wealth, those big returns are not going to be well captured by a wealth tax. They're not the thing that the wealth tax is capturing. Whereas things like capital gains tax are much better targeted at that. So the combination of they have disincentive effects, they are practically very difficult to do, and there are better options available is basically why we're saying we wouldn't go down the new annual wealth tax route. Stuart, do you want to add anything to that?
Well, so since the question's been asked and you haven't addressed it so far, let me pick up on the international experience point a bit. I think the question says Norway and Spain have wealth taxes that raise quite a lot. Actually, Norway and Spain's wealth taxes don't raise very much revenue at all. The country that has a wealth tax that does raise a significant amount of revenue, I mean, say more than 1% of GDP rather than, say, 0.1, 0.2, 0.3% of GDP, is Switzerland. But Switzerland essentially doesn't really have a capital gains tax or an inheritance tax. The wealth tax you can think of as being essentially instead of those taxes. And for the reasons that Helen mentioned, we actually think that having a well-functioning capital gains tax and inheritance tax and so on would be better than having an annual wealth tax. I think that there are reasons that wealth taxes haven't worked very well internationally, and so while they do still exist in Switzerland, Spain, and Norway, they've been abolished in almost every other rich country. I think every other rich country that had them. What you've tended to find is that for a combination of the practical reasons that Helen mentioned, I mean, valuing some kinds of assets is just really hard, and for political reasons, they've often ended up exempting broad swathes of assets, which in itself undermines the revenue yield, but also means that people just shift their wealth into tax-exempt assets, which means you lose even more of the potential revenue, and you're distorting people's asset allocations and harming growth and so on at the same time. Now, that also links to, I mean, we've been discussing wealth taxes in the abstract so far. It's worth being very clear, there is a big difference between a wealth tax that would apply to billionaires and a wealth tax that would apply to millionaires, or even, you know, as it were, the ordinary middle classes. I mean, the bulk of wealth in this country, about 75–80%, depending on how you measure it, is people's houses and pensions. And you can, you know, there is potentially a large amount of revenue to be raised there, but you have to, you know, bear in mind what you're doing there, that will hit large swathes of the population and can be politically difficult, as well as having other difficulties. The more you try and focus it on a very small number of very rich people, or essentially try and soften it by taking out a lot of assets, like exempting houses and pensions and things like that, the harder it gets to raise significant amounts of revenue, and the more you risk distorting activity, people leaving open opportunities to avoid or evade the tax. And as Helen said, if you're really trying to raise very large sums from very small numbers of people, there's a risk that they might just leave the UK completely.
Great, thank you. Let's take a question from Joel Hills at ITV. I'll read the question. Leaving manifesto pledges to one side, what would be the best way of raising an extra 30 billion while minimising damage to economic growth? So let me, I guess, first say that there isn't one single best way of raising tax. There's another comment somewhere on this list basically saying, why haven't we talked about distributional effects? They matter too. And of course, they absolutely matter. Now, the chapter, we talk much more broadly about the whole set of effects that taxes have, including on distribution and work incentives and savings incentives and so on. So there isn't, we're not coming off the fence and saying, here's how you should do it, because it's a political choice and there are lots of things to weigh up. But taking that question about, you know, how do you raise 30 billion without damaging growth? I mean, look, I think it partly depends on what you're willing to do. So if all you're willing to do is say, I'm just going to change a tax rate, then I think you want to try to find a tax that's on a bigger base, a broader base, is going to have fewer distortionary effects. Maybe something like income tax would be part of the mix. But I think really importantly, it's absolutely where we should be thinking about reform. So for example, if you just put up capital gains tax rates as they currently are, I'd say that's really bad for growth, because you're going to discourage various forms of investment. If you reform the capital gains tax treatment so that you had a more sensible tax base, and you could basically take kind of investment costs out of the tax base and just tax what economists would call excess returns, that could be a much better thing to do. So I think what's the answer? How do you raise 30 billion with the least effect on growth? You get serious about tax reform, and you get serious about looking at how you can make the current taxes we have less distortionary. Then maybe you increase some of them. But also worth saying that you're not going to increase 30 billion worth of taxes without having some effect on growth. Stuart, anything to add to that?
So to be more specific about one thing, if you were to ask me which taxes could you raise that will do least damage to growth, I would probably say recurrent property taxes. So taxes on land or something like council tax actually does much less to damage growth than income taxes, VAT, corporation tax, and so on. Basically because land is in fixed supply pretty much, and actually the building of new buildings don't respond very much to tax, and you can't hide it very easily, and it can't leave the country, and so on. And so, you know, the OECD have been making this case for years, but others as well, that actually property taxes, other than, you know, particularly damaging kinds like stamp duties, are possibly the least damaging taxes for growth. But first of all, again, there are political constraints on that, but the political constraints are also partly there for a reason. There are fairness questions as to, if you wanted to raise a lot more tax, do you really want to do it only on people whose wealth is in housing rather than their wealth being in pensions or some other forms, or people who choose to consume a lot of housing rather than having expensive cars and taking foreign holidays or whatever. Is it actually fair just to say, let's put a big extra burden on people living in expensive houses or people who own expensive houses? And the effect on growth is an important question. It's one that is that the government has quite reasonably chosen to prioritise, but it can never be the whole story. You have to think about all of the other effects that taxes have as well, and the political decision as to who do you want to bear more of the burden.
Great, thank you. Isaac, some questions about pensions here. So I'll ask you two at the same time because they're a bit related. So one is, could you expand on why capping pensions relief would be unfair and distortionary? And what are the drawbacks of the 25% tax-free withdrawal, and why is it considered poorly targeted?
Sure. I might take those in reverse order. So the the tax-free 25%, if you think about the benefit that gives, giving people a large amount of their pension they can take tax-free, well, that benefits people most who would otherwise have paid the most tax on it. So if you're someone who has a high income in retirement, and you maybe would have paid the higher rate of income tax on your withdrawals from your pension, that tax-free 25% is worth an awful lot of money. Now, if the idea of subsidising pension saving through this policy is to try and prevent people from undersaving, prevent people from having to rely, for instance, on benefits during retirement, then it doesn't seem like this is a particularly well-targeted policy, not least because if your income is at the very lowest end and you're not a taxpayer at all in retirement, you don't get any benefit from the tax-free 25%. So if the idea of the policy is to help prevent undersaving, this is really quite a bizarre way to try and do it. And you could curb the giveaway to the highest income pensioners while strengthening subsidies for those at the lowest incomes, those at most risk of undersaving, while still raising revenue overall. In terms of capping upfront contributions and why we think that's probably not the right way to go, I think one thing you have to ask yourself is, why would you want to tax pensions in that way? Now, there's an argument for saying we should tax pensions as we currently do, where we delay the tax liability until later on. As I explained, that has some benefits. But if you're taxing at both ends, you're really making the system much, much less coherent. You've got to think about both the upfront contribution and when it's withdrawn in terms of tax. So you'd end up with a system where, for some people, they'd be contributing and paying say 20% or even more tax when they contribute, and then paying tax again when it came out. For those people, it would be a very tax disadvantaged vehicle suddenly, a pension. And then at the same time, you'll have some people who currently get pensions tax relief because they contribute and they get tax relief, and then they're non-taxpayers in retirement. Now, we don't see people tending to complain about that very much. That suggests that actually what people are suggesting here is just a way to try and tax higher income people more. Now, if that's your objective, then just do it directly. It's not particularly sensible to try and do it in some very convoluted way through the pensions tax system.
And perhaps to summarise some of that, I mean, we have a system, the income tax system of pensions at least, that is coherent in the sense that we relieve pension contributions on the way in, we tax them on the way out. We could alternatively tax them on the way in and relieve them on the way out. We could debate which of those systems is better, but they would both be coherent. What is absolutely not coherent is taxing pensions on the way in and on the way out. I think part of the problem with this debate is that when people talk about wanting to relieve contributions up front, they don't simultaneously talk about what you would do with pensions in receipt. And those debates have to be put back together again. We should be thinking about both on the way in and on the way out. And that's really the heart of why we're saying it would be unfair and distortionary to change how you tax on the way in and ignore how you tax on the way out. Another question here that Stuart's going to love. This is related to something we've been working on for very many years together. So I'll let you have the first crack, Stuart. What would the impact of equalising taxes on income from wealth, so for example, capital gains tax, dividend tax, etc., with income from work be on economic growth? Would it be positive or negative?
Well, So the first thing to say is when you talk about equalising them, you can equalise by levelling up or by levelling down. So there's a case, other things being equal, I'll come back to the other things in a minute, there is a case for taxing income from all sources at the same rates. That doesn't mean that everything has to be done at the highest rates we have now. You could also reduce employment taxes and meet in the middle somewhere, and obviously that would have a big effect. If we're just talking about increasing tax rates on income from wealth, dividends and capital gains, and so on, as with most tax increases, that would be somewhat detrimental to growth. It would have the advantage of reducing the disparity between employment income and capital income, and reducing, for example, the incentive to set up as a business and work through a company instead of working as an employee, or to put it another way, reduce the incentive for businesses to hire self-employed contractors rather than hiring employees, which is a strange incentive in the system at the moment. The big disadvantage is that it would discourage saving and investment, and risk-taking and entrepreneurship as it stands, and also discouraging working to generate the capital that gets invested in the first place. I think the point that Isaac was making in his presentation, which we've been kind of hammering on at for years, is that it doesn't have to be that bad. There are things that you can do that are better. And so if you change the way that we tax returns to wealth, so if you give people full deductions for the amount they save and invest in the first place, and there's more than one way you can do that, which might be a discussion for another day. If you don't have things like capital gains tax forgiveness at death, which encourages people to hold on to assets till they die, if you were more generous in the treatment of losses, so you treat gains and losses more symmetrically, so we don't discourage risk-taking as much, if you'd make these reforms to make the system work better, change the design of it, then you could raise rates with much less damage to economic growth. It may well be possible to have a reform that is net revenue raising from those who are better off, and still actually increases rather than reduces economic growth.
Yep. Wonderful, thank you. And there really is, we've been working on this for years, and there really is a big prize here to be had from actually properly tackling the reform of this area. Right, there's a bunch of questions here about the corporation tax gap. So let me take a few of those together. Some of the questions are basically what's happening and why is it going up? Another particular question says, is it also an employment generator? HMRC staff were cut drastically. Basically, could we have more of them? So maybe I'll have a first bash at that. I mean, so Isaac showed you that very stark chart of the corporation tax gap going up very steeply. I think basically there's more work to be done to work out exactly what is happening there. People do point to things like increasing complexity and therefore compliance costs for taxpayers. It's harder to work out what your tax liability is. Cuts to HMRC, some of their compliance or some of their helpline kind of work may make it harder for people to get help filling in their tax forms. We also have a big incentive for individuals to operate through a company. It might be that more people are moving into operating a company and not getting their corporation tax liabilities right. But I think there's really a question to be answered about why it's risen so starkly in the last few years. On the point about wouldn't it be a win-win if we got lower, the compliance, if the tax gap came down and the employment went up, I can't resist the urge to point out that we don't care about employment per se. And actually, it would be nice not to have lots more tax inspectors having to go out and collect taxes, which I think really speaks to thinking not just about taking the current tax system as given and working out how we can improve compliance, but also thinking about how you design that system, how complex it is, how easy it is to navigate. The fact that we have this big incentive that's pushing people into operating companies, not because it's the best legal form for them to operate under, but because of this big tax incentive. I think really thinking both about the compliance issues and about the broader design of the system, that kind of two-pronged approach will be the best one for thinking about how we really tackle what is a very large tax gap. Okay, let's take some more questions. There's okay, the top one now. I'll ask you, Isaac. What's the view on destructive tax cliff edges? So, for example, the 100,000K and the annual allowance tapers in pensions. So we hate them. Isaac, tell us more.
Yeah, absolutely. So this is something I didn't have time to mention. There are too many elements of the tax system that could do with reform to mention in one 20-minute presentation. But it's definitely the case that effectively what we have between £100,000 and about £125,000 is, at least on employment income, an effective marginal tax rate of about 62%. Now, without taking a view on how high rates should be on various different forms of income, people at different income levels, having an income tax system where rates go from 40% up to 62% and then back down to 40% to 6%, and then back down to 45% is a frankly pretty bizarre way to set up a tax system. If you were designing it from scratch, you definitely wouldn't do it that way. It creates all kinds of strange distortions to people's work incentives. So that definitely is something that would like the Chancellor to look at and like the Chancellor to try and reform. And you can see this. You can see these cliff edges in many different parts of the tax system, in fact. So you could also see them in terms of where child benefit is withdrawn from people. For those who are affected, that can create very high marginal tax rates. Equally, for the withdrawal of of free childcare entitlements at £100,000. Again, this can create incredibly high tax rates for those people who are affected. So there are quite a lot of these features in the tax system, and it would definitely be a positive thing to see the Chancellor trying to move to a system where we don't have these kinds of very large spikes in marginal tax rates. Frankly, pretty difficult to defend points.
Stuart, there's a great question here about basically about carbon taxes. I'm going to ask to you. Do we have an accurate methodology for a genuine economy-wide carbon tax? Calculating an accurate carbon footprint for a supply chain, for example, is very difficult and requires a lot of assumptions. But how do we actually do a carbon tax? Is how I interpret that question.
Yeah. So, I mean, well, there's an element of detailed technical expertise that I don't have there, but I think there are two parts to this. Domestically, most of it comes from burning fossil fuels, and you can reasonably well measure the carbon footprint associated with that. It often helps if you just do this upstream. So, for example, at the point that the fossil fuels are being burnt, rather than trying to calculate the carbon footprint associated with each good and so on. Now, there are some things that are clearly harder to do than that. So when you get into agriculture and things like how you treat peatlands and afforestation, and there's a whole bunch of things that make it more complicated. Where I think it actually the interesting and tricky area really comes is internationally. So we are at the moment in the process of introducing a so-called CBAM, a carbon border adjustment mechanism. The idea being that we want to tax the carbon emissions associated with stuff consumed in the UK, not necessarily where the greenhouse gases are emitted in the UK. And so that's partly because we don't just want to say, well, let's get all of our emitting done in China and we will import the stuff produced. That's no help for our economy, and it doesn't help with global emissions either. And so the UK, and for that matter, the EU, is trying to move towards this system where we tax the carbon embedded in imports, not just carbon emitted domestically in the UK. And measuring the carbon embedded in imports, that is much harder. That is a real challenge, and that the CBAM mechanisms designs as currently proposed actually don't do that very well. It might be possible to improve them. Of course, the ideal would be to get international, well, if not a wonderful coordinated international harmonized way of doing things, at least try and get other countries to tax their carbon emissions domestically as well, so that globally all the emissions get taxed. So there is an even longer answer to that, but I will stop there. I mean, I think there are some challenges, and I think the biggest challenges are in the international sphere. But domestically, I think actually we could have a pretty good stab at it, and we could certainly have a much better stab than we have at the moment, where we don't even try to levy a consistent carbon tax on all sources of emissions. We have a whole range of different policies that create very weird combination of incentives to emit, bigger and smaller incentives to decarbonize in different ways, which makes decarbonisation much more costly in terms of how much GDP, how much economic growth we have to sacrifice for any given reduction in emissions. So we could certainly do a lot better than we do now.
And I'd really underline that last point, that even if we think we can't get to the perfect tax, what we've got currently is nowhere close. Right, we're running up to towards the stop, and there is still a whole bunch of wonderful questions. So I'll take a difficult question, so you can hear our response to it. So a bunch of questions here basically about gambling taxes. I'm going to point this towards you, Stuart. Just to pick one of them, Joel from ITV asks, so the IPPR says that the government can raise 3 billion by changing the way that gambling is taxed. Industry say hiking the duties would harm jobs while failing to deliver more revenue as punted into the black market. Who is right? So gambling taxes is a tricky one. Stuart.
Yes, so several things to say about this. I mean, first of all, yes, it would be possible to raise more revenue from gambling taxes. How much just depends on, how high you make the tax rates. It is also true to say that if you put up gambling taxes, that would reduce gambling, and there would be, jobs and so on that went with that. Although, of course, almost anything that you increase taxes on, you would see less of that and less of the jobs and production and so on that go with that. There's a broader question as to how the taxation of gambling should be designed. And at the moment, we've got, depending on how you count it, about 6, 7, 8 different taxes on gambling of different kinds. There was a new one that just came in this April. The government is also in the the government has just run a consultation on how to tax remote gambling, kind of gambling online where the firms may be based overseas, which didn't used to be taxed at all, is now taxed, but is taxed in quite a complicated way. And actually, that is now the majority of all gambling that happens in the UK. So the government is currently looking at consolidating the different taxes on remote gambling into one single one. I think more broadly, there is certainly a simplification that could happen. There are reforms that could happen. It is quite a difficult thing to get right, because there are tricky conceptual as well as practical questions here. So one is, particularly when it comes to things like spread betting on financial markets, how do you distinguish what might be gambling from what is essentially a risky investment? And so when are people just, when is this a consumption good? And my leisure activity is gambling, and we want to tax that like we tax any other consumption, versus when am I making an investment that I might make a loss on? And actually, we don't want to tax people on that. That's quite tricky. The second thing is, to the extent that we think that there are harms associated with gambling, and certainly there is, problem gambling in the UK, that's not most gambling, but there is an element of it. How do we identify and target taxes on that, which is presumably the only real argument for taxing gambling more than we tax anything else, is the harms that can be associated with it? Well, figuring out what harms are associated with what kinds of gambling, and how do we make the tax system reflect that without making it phenomenally complicated, is a real challenge. So I think there definitely are challenges there. I also think there are almost certainly improvements that could be made to the current system. Whether and how much we should be raising more revenue from it, again, I don't want to come off the fence on.
Brilliant, thank you. So we're at time, so we had to stop, sadly. There is lots and lots more in the chapter, so do go check it out. And I say, as you'll have seen, the theme throughout this is clearly that the Chancellor could raise revenue. Raising revenue actually isn't the particularly hard bit. What's hard is raising revenue well and doing it without distortion. So reform is the opportunity that Rachel Reeves should absolutely grab at this budget. But for now, let me say thank you to Isaac, thank you to Stuart, thank you to all of you who've sent in wonderful questions and listened. And we look forward to seeing you next time.